Hi, this is Marlena Lee with Dimensional Fund Advisors. I am a member of our research team. Thank you very much for joining me for this presentation on the topic of government debt. So in this presentation, we'll look at economic theories as well as historical evidence to try and assess the potential impact of government debt on things like economic growth and investment returns. So it's clear that many nations face fiscal challenges. Let's just put some concrete numbers on the situation. In the blue bars, I show you the OECD projections for 2010 debt levels as a percent of GDP. You can see that over half of these countries now have debt levels exceeding 70%. And what makes the situation even more worrying is that debt levels continue to increase. So in the orange bars, I indicate deficit levels, which continue to be high for many of these countries. Longer-term challenges such as rising healthcare costs and aging populations further complicate the fiscal situation in many of these countries. So these numbers are worrying, and they have prompted many questions about whether government debt will hamper economic growth. And a related question is whether or not this will affect future returns. We'll see that both theory and historical data tend to lend some support to the idea that government debt will cause detrimental headwinds for economic growth. However, there's no evidence that government debt's associated with lower investment returns. So this is consistent with the notion that markets have already priced in the long-run potential impact of government debt. Before we jump into the empirical results, I think it's really useful to think about the impact of government debt using a few national accounting identities. So the first one is just that national savings equals private savings plus public savings. Private savings occurs when households spend less than their after-tax income. And public savings occurs when governments run budget surpluses. So the total of all of that savings is what we use to fund investment. And the returns on those investments represents future income to the constituents of a nation. So let's think about what happens when there is an increase in deficits. Public savings goes down, and that means national savings also goes down. This means investments must also decline, and because we own less assets, future national income will also go down. So far, this analysis has only relied on identities, so nothing too controversial. What we're not certain about is whether the decline in national investment will occur through a reduction in domestic investment or in net foreign investment. If we observe a reduction in domestic investment, what we might see is that private investment gets crowded out through higher interest rates. Reductions in domestic investment might also mean lower future GDP growth. On the other hand, if the decline in investment occurs through a decline in net foreign investment, in other words, through a current account deficit, this could have exchange rate implications. So there are many predictions that came out of the previous analysis, and here I've categorized them into two different groups. The first group is economic questions, in other words, the ones that don't give any guidance on what you should do in your portfolio. So we'll look at things like whether or not deficits tend to crowd out private investment through higher interest rates, and whether or not that has any impact on long-run economic growth. And we also saw that we might not actually observe any changes in domestic investment if we borrow enough from other countries. So we'll also look at whether or not fiscal deficits cause current account deficits. The answers to all of these questions are interesting, but they don't have investment implications unless current debt levels or current deficit levels also tell us something about future expected returns or future exchange rate movements. We'll document a few interesting economic relationships, but we'll find that investment implications are much harder to come by. So the first thing we'll look for is evidence that deficits tend to crowd out private investment through higher interest rates. This plot shows that, yes, long-term interest rates are higher when expected deficits are high. So in January of each year, the Congressional Budget Office releases a projection of future deficits given current laws. This estimate is shown on this graph on the horizontal axes. On the vertical axes, we have the yield spread in 5-year treasuries. So the trend line is upward sloping, and it shows that the yield spread tends to increase by about 29 basis points when we have a 1 percentage point increase in projected deficits. Now notice the timing of this chart. I have today's interest rates plotted against expected future deficits. However, before you make any changes to your bond portfolio, we need to check whether today's deficits predict anything about tomorrow's interest rates. On this slide, I show you the results of those predictive regressions. Here we're trying to predict changes in the yield curve, so those are the tables on the left, or changes in bond returns, those are the tables on the right. And in case it's been a while since you've seen a linear regression, recall that we're looking for t-statistics that are bigger than 2 in absolute value. You can see that all of the t-statistics on this slide are far below 2. In other words, information that we have about today's deficits and today's debts do not predict anything about tomorrow's yield curve or tomorrow's bond returns. So checking back with our roadmap, we have seen some crowding out effects in terms of higher interest rates. The next logical question is whether or not this has any impact on future GDP growth. Here's a plot of tomorrow's GDP growth on today's deficits. The data is from the World Bank and includes 67 different countries. If deficits have a tendency to stifle future GDP growth, what you expect to see is that the trend line should be downward sloping. This is what we observe, but the relationship is not at all obvious. However, this plot includes all countries, even those with very low levels of debt. It may be the case that deficits only tend to have a negative impact on future GDP growth for countries that already are experiencing high levels of debt. So in this slide, I show you countries where debt to GDP already exceeds 30%. Here, 50%. And here, 70%. The negative relationship between deficits and future GDP growth is much more evident when we are looking at just high debt countries. And recall the first slide where we saw that over half of the OECD countries now have debt levels exceeding 70%. Here are the statistics for those trend lines we saw in the previous plots. We can see that the slope of the line is monotonically increasing as we move from the sample of all countries to just those with high debt. We observe that the R-squared also increases from about 0 to 0.12. This means that once we have countries with debt to GDP levels of over 70%, 12% of the variation of future GDP growth can be explained by current deficit levels. This also means that 88% of the variation is unrelated to deficits. Thus, the historical data suggests that high deficits might be producing some headwinds as far as future economic growth, but that slow economic growth is not necessarily guaranteed. Even if future GDP growth is slow, this doesn't necessarily mean that equity returns are going to be low. That's what I show using the experiment on this slide. What I do is I take all of the countries in the MSCI universe and I divide them into high growth countries and low growth countries. The results show that there is no statistical difference in the returns of high growth countries versus low growth countries. In fact, low growth countries had higher average returns than the high growth countries. For example, in the developed countries, the low growth countries had returns of 13.5%, even while they had GDP growth of -4%. Similarly, for the emerging markets, the low growth countries had average returns of about 25%, even while they had GDP growth of -5%. So we've seen some worrying patterns for economic growth, but nothing that should necessarily concern international equity investors. The final piece of the puzzle is whether we borrow more from foreigners when there are fiscal deficits, and whether or not this has any implications for the dollar. So far, we've been talking about fiscal deficits. That occurs when the government has greater expenditures than their revenues. Now let's introduce a different type of deficit, the current account deficit. That occurs when our payments to the rest of the world exceeds our receipts. For most countries, the largest component of the current account deficit is the trade deficit. There is this hypothesis called the twin deficits hypothesis, which hypothesizes that fiscal deficits tend to cause current account deficits. On this slide, I show you the fiscal balance and the current account balance for the United States starting in 1973. If the twin deficits hypothesis holds, then the lines shown on this plot, which are the fiscal balance and current account balance in the United States since 1973, we should observe that the lines move together. We can observe that there are several instances where it seems like the lines are moving in opposite directions, particularly starting in the 80s, running all the way through the early 2000s. The lines do seem to be negatively correlated as opposed to positively correlated. So there doesn't seem to be much evidence, at least in the United States, that the twin deficits hypothesis holds. So while the twin deficits hypothesis is interesting from an economic standpoint, most investors care about the implications on their portfolios. For example, it's commonly believed that large fiscal deficits cause currency depreciation. As governments run large fiscal deficits, investors become worried about things like inflation risk and default risk, thus making currencies less attractive. As investors flee from these currencies, it causes the currency to decline. This does seem to be supported by the recent experience in the United States. So on this plot, I show you the fiscal balance and the value of the dollar measured against a trade-weighted basket of currencies. If large fiscal deficits cause currency depreciation, we would expect these lines to move together. This is what we observed starting in the late 80s. However, if we look earlier in the period, from the mid-70s through the late 80s, we find the exact reverse pattern. We find that whenever the fiscal balance deteriorates, in fact, the dollar tends to strengthen. Thus, depending on which sample you're looking at, you may or may not find support for this idea that fiscal deficits cause currency depreciation. It's also commonly believed that current account deficits are associated with currency appreciation. So recall that current account deficits are typically made up mostly of the trade deficit. What happens when we run a trade deficit? That means that we tend to import more than we are exporting. And strong currencies make imports cheaper and exports more expensive. Here I show you the current account balance and the US dollar for that same time period. If it's true that current account deficits are associated with currency appreciation, what we should observe are these lines moving in opposite directions. It's not clear that this is the case. So the finding that fiscal deficits and current account deficits do not predict future exchange rate movements is not really that surprising in light of findings of other academic studies. Meese and Rogoff wrote a paper in the 80s, and they looked at all of the major exchange rate forecasting models that were developed in the 70s. And what they found was that a simple random walk model outperformed all of these forecasting models. Recall that a random walk model just says that the best forecast for exchange rates tomorrow is just the exchange rate today. Now fast forward 25 years. Rogoff found a new grad student to do most of the work, and they found very similar results. So 25 years of new data, new statistical techniques, and still what they found was that many of these exchange rate forecasting models just couldn't reliably outpredict a simple random walk model. So to conclude, we have uncovered some worrisome links between deficits and long-run economic growth. Are we entering into a period of a new normal? Perhaps. However, investment implications are much harder to come by. We haven't uncovered any evidence that deficits can predict future bond or equity returns, and we haven't uncovered anything that seems to predict short-term exchange rate movements. However, we have uncovered these worrisome links between deficits and economic growth. So how do we reconcile this? Well, markets have already incorporated all of this information in today's price, and economics tells us that future market returns going forward must be positive.